Welcome to this comprehensive guide on tokenomics, the fundamental economics behind cryptocurrencies. Tokenomics combines the words token and economics, representing the study of how digital tokens work within blockchain ecosystems. Understanding tokenomics is essential for anyone looking to invest in or build cryptocurrency projects. Tokenomics is the study of economic systems that govern cryptocurrency tokens. It encompasses how tokens are created, how they are distributed among participants, and what mechanisms drive their value. Think of it as the blueprint that determines a token's supply, demand, and overall economic structure within its blockchain network. Tokenomics consists of four key components. First, token supply refers to the maximum and circulating supply mechanics that control how many tokens exist. Second, distribution determines how tokens are allocated across different stakeholders like investors, developers, and users. Third, utility defines the actual use cases and practical value the token provides. Finally, incentives are the rewards and mechanisms that encourage people to participate in the network. There are three main token supply models. Fixed supply means there is a capped maximum number of tokens that will ever exist, with Bitcoin's 21 million coin limit being the most famous example. Inflationary supply involves new tokens being continuously minted over time, gradually increasing the total supply. Deflationary supply uses token burning mechanisms where tokens are permanently removed from circulation, reducing the total supply and potentially increasing scarcity. Two critical supply metrics help evaluate any cryptocurrency. Total supply represents all tokens that will ever exist, which can be either infinite or fixed depending on the project's design. Circulating supply refers to tokens that are currently active and available in the market for trading and use. The difference between these two metrics reveals how many tokens are locked, reserved, or yet to be released. Projects use various methods to distribute tokens. Initial coin offerings, or ICOs, involve public crowdfunding sales where investors purchase tokens during the launch phase. Airdrops are free distributions of tokens to community members, often used to build awareness and reward early adopters. Mining and staking rewards allow users to earn tokens by actively participating in network security and validation processes. A typical token allocation structure might look like this. 40% goes to public sale, making tokens available to general investors. 20% is reserved for the team and advisors who build and guide the project. 25% supports ecosystem development, funding partnerships, marketing, and platform growth. The remaining 15% forms a reserve fund for future needs and emergencies. Tokens serve different purposes based on their utility type. Governance tokens grant holders voting rights on important protocol decisions, allowing them to shape the project's future. Utility tokens provide access to platform services and features, functioning as the currency within a specific ecosystem. Security tokens represent ownership stakes or profit-sharing rights, similar to traditional securities, but on the blockchain. Projects implement various incentive mechanisms to encourage participation. Staking rewards allow users to lock their tokens and earn passive income over time. Liquidity mining rewards users who provide liquidity to decentralized exchanges, helping maintain healthy trading markets. Token burns permanently remove tokens from circulation, reducing supply to increase scarcity and potentially drive up value for remaining holders. Before investing in any cryptocurrency, evaluate its tokenomics carefully. Check for supply transparency to ensure you understand how many tokens exist and will be created. Examine the distribution model to verify it's fair and doesn't overly favor insiders. Assess whether the token has clear utility value and solves real problems. Finally, determine if the incentive structure is sustainable long-term without relying on unsustainable rewards. Strong tokenomics is a foundation for successful cryptocurrency projects.
If you like this video, hit that like button and don't forget to subscribe. Visit codelucky.com for more such useful content.